every imported product, every song streamed from overseas, every remittance sent home. It's all the balance of payments. I'll break down the 3 accounts. Let's go. What is the balance of payments? The balance of payments shows all the payments and receipts between one country and all the other countries it trades with. There are 3 main accounts: the current account, the capital account, and the financial account. We're going to break down all 3. The current account has 4 sections or 4 accounts: visible trade, invisible trade, primary income, and secondary income. Visible trade, physical things such as cars, coffee, electronics. Invisible trade, services such as tourism, banking, and education. Primary income, profits and interests and dividends earned from foreign investments, as well as income credits from temporary wages of citizens working abroad. Secondary income includes payments made and receipts received for which there's no corresponding exchange of an actual good or service. Foreign aid and transfer by workers abroad, so worker remittances, worker pay, as well as taxes and excise duties between countries. Now, the fundamental difference between employee compensation from the primary section and worker remittances from the secondary income section lies in resident status of the worker and whether the money is payment for labor or a transfer of funds. So to make it a little bit more clear, so in the primary income section, it's short-term income, and it is payment for services rendered, whereas in the secondary income section, it's longer-term income, and it's a transfer of workers' income to family, so there's no services rendered. So this is an example of a current account in the balance of payments. So we'll have the balance of trade, we will have the balance of services, the primary income, and the secondary income, and that will give us the total of the current account. The capital account is usually smaller but very important, sometimes combined with the financial accounts. Sometimes they're seen as the same thing. In the capital account, it also has its own little sections: capital transfers, acquisition or disposal of non-produced or non-financial assets. Capital transfers, these include debt forgiveness or debt cancellation and the transfer of ownership of fixed assets. The acquisition or disposal of non-produced, non-financial assets, these include intangible assets like patents, copyrights, trademarks, franchises, and leasing, as well as land rights from foreign embassies. Now, the last account, which is the financial account, last but not least, has 5 sections of its own: direct investment, portfolio investment, financial derivatives, other investment, and reserve assets. Direct investment, a foreign company building a factory in your country. For example, these multinational companies like Coca-Cola or Toyota. Portfolio investment, buying shares or bonds in companies overseas. For example, if you buy shares in Coca-Cola, but you are a UK resident. Financial derivatives, currency swaps, interest rate options, and employee stock options held by non-residents. Reserve assets, changes in government stash of gold and foreign currency reserves, as well as SDRs. Now, what are SDRs? Those are special drawing rights, are international digital reserve assets created by the International Monetary Fund, or the IMF. They are not physical currency and are used exclusively by governments and central banks to boost official national reserves. IMF is the International Monetary Fund. It stabilizes the global economy by fostering financial cooperation and providing loans to countries in financial distress. Other investment is a residual financial account category tracking non-classified transactions. It primarily includes holding foreign currency and deposits alongside trade credits extended by exporters directly to foreign buyers. If money flows in, we call it a credit, a plus. So inflows, like money coming in from exports. If money flows out of the economy, we call it a debit. Money is leaving the economy. Now we need to manage the balance of payments. So if there's a deficit, this is when more money leaves the economy than it enters it. We cover this gap by borrowing or using national reserves, like foreign currency reserves or gold reserves, to make up for that difference. Now, a surplus is when more money enters the economy than leaves it. This extra cash can be used to pay off any debts that the country owes or saved for the future. Now, the whole thing around balance of payment is that it should balance, which we know it doesn't because you have deficits and surpluses. But the net errors and omissions section is a balancing item used to make sure the accounts total to zero or balances. Let's look at a balance of payments. We start with the current account, then we have the capital account, then we have the financial account, then we put them all together, then we have net errors and omissions. Let me just show you. So if your balance of payments is in a deficit, that minus sign indicates that it's a deficit, so more money going out than money coming into the economy. Then this needs to be balanced with the net errors and omissions of a positive amount. If you like these PowerPoint presentations, they are available on my community for download if you sign up. YouTube believes you'd like this other video, so be sure to check it out as well. See you in the next one. Bye-bye.